Fiscal policy does work, but at a very high cost. And here it is. So the U.S. economy in the fourth quarter of 2023, and we're seeing something similar in the first quarter of 2024. We won't have that data for a couple more weeks, but it looks like it's growing about 2.4%, 2.5%, which, it's low compared to potential, but it's decent growth. But how much is the debt going up at the same time? The debt's going up faster. The debt's going up like 3.5% on an annualized basis. So are you running deficits? Yes. Are you getting some growth? Yes. But the debt is going up faster than the growth. And so this shows up in a measurement called debt-to-GDP. Because people throw around big numbers, and they are big numbers. $37 trillion of national debt. That's about right. But you can't really make sense of that number unless you put it in the context of the size of the economy. I always, simple example. If you owe $20,000 on your MasterCard, is that a lot or not? Well, if you make $20,000 a year, it's a lot. You're probably going bankrupt. If you make $500,000 a year, you can just write a check. And so you can't really learn much from the number, from the size of the debt. You have to compare it to the size of the economy. So what's that number? Well, that number is it's over 130% right now, which, by the way, is the highest in U.S. history. That's a very helpful chart, Matt. That goes back to the late 1960s, so it's a good time frame. The last time, by the way, the number we have today, 130%, a little bit higher, is the highest in U.S. history. The last time it was even close was the end of World War II. It was about 120%. Today, it's about 132%. So it's the highest in history, highest at the end of World War II. But even in World War II, I like to say, well, we won the war. Yeah, we spent a lot of money. We ran up a lot of debt, but we won the war with our allies. And the U.S. was a global hegemon. Our percentage of global production, global capacity, automobiles, like whatever, it was off the charts. And we had a long run as the superpower. Today, we've got a higher debt to GDP ratio, but we haven't won any wars lately. We're losing on, Ukraine, losing in the Middle East. No one really respects the United States. We've got brain dead leadership, et cetera. So we're not getting anything for our money. We're wasting the money. But it does have that effect I described. But the problem is at lower levels of debt. So let's say the debt to GDP ratio. Look at 1980, for example. 80.
Jim Rickards delves into the complexities of fiscal policy and its repercussions on economic growth and debt. He starts by highlighting the recent growth of the U.S. economy, which, while at 2.4–2.5%, is overshadowed by the faster pace of debt accumulation, leading to a historic debt-to-GDP ratio of over 130%. Drawing parallels to previous periods such as the end of World War II and the Reagan era, Rickards emphasizes how economic growth once outpaced debt accumulation, leading to a decline in the debt-to-GDP ratio. However, the current scenario sees debt growing faster than the economy, indicating a worrisome trend.
One around there. It's about 30%. Yeah, it's a really good. Okay, so 81, 30%. So that's when Ronald Reagan was sworn in. The beginning of 1981, he was sworn in. That was the low. That was the lowest since World War II. I said it was 120% at the end of World War II. Yeah, but it was 30% in 1981 when Ronald Reagan was sworn in. So how did you get from 120% to 30%? Because we had a lot of deficits. There were some surpluses, but mostly deficits during that time period. Well, the answer is we grew the economy. The debt went up. It's not that the debt went down. The ratio went down. Even as the debt was going up, the economy was going up faster. So, it's seventh grade math. If you have a numerator and denominator, if the denominator is growing faster, the denominator is GDP. If the denominator is going faster than the debt, then the ratio is going down. What we have now is the opposite, where the numerator is growing faster than the denominator. The debt is growing faster than the economy, which means the ratio is going up. So at a certain level, and by the way, the level is around 90% debt to GDP. So where do we hit? We hit 90%, like around 2012. Yeah, there it is. 2010. Welcome, Obama. So below 90%, here's what happens. You borrow $1, you spend $1, and you get more than $1 of growth. So you borrow $1, you spend $1, and you get $1.25 of growth. That's actually good, assuming you don't waste the money. That's a separate issue. But as long as the growth is greater than the debt, then your ratio is going down and your economy is solid. But as you get closer to 90%, that payoff that called the Keynesian multiplier gets smaller. It starts to shrink. So you start out when you're down around where we were in the 80s, even the mid 90s. You borrow $1, you spend $1, you get maybe $1.25, but then it's like $1.20 and it's $1.10, and then as you get higher and higher, as you get closer and closer to 90%, it shrinks until you get to a point where you borrow $1, you spend $1, and you get 90 cents of growth. You don't get your dollar back. You don't get the dollar of growth. You get maybe 90 cents. Now, it's still growth. It's still growth. Somebody got paid, somebody got a job, etc.
Rickards explains the concept of the Keynesian multiplier, which suggests that at lower levels of debt, borrowing can stimulate growth. Yet, as the debt-to-GDP ratio surpasses 90%, this multiplier diminishes, eventually leading to slower growth and potential recession. He warns of the impending consequences, such as prolonged economic stagnation, widening wealth gaps, and reduced productivity. While default may not be an option for the U.S. due to its ability to print money, the alternative of hyperinflation poses severe risks.
But your debt's going up faster, and as it goes up even higher, that multiplier, which is once it goes below 1, you're digging yourself into a hole, but it shrinks very rapidly. In the fourth quarter of 2023, so not that long ago, that multiplier was 0.68. Meaning you borrow $1, you spend $1, you only got 68 cents of growth, not even close to $1. I've seen other studies that show it could be as low as 40%. So, okay, so now the debt to GDP ratio is at an all-time high. We're not getting $1's worth of growth for $1 spent, but you're still getting growth. And see, this is the part people don't understand. This is the part the politicians don't bother to explain. They point to the growth figure, say, look, we got some growth, and we did. But they ignored the debt figure, and that's going faster than the growth. So how does that end? So I just described the problem. How does it end? It ends in one of several ways. For most countries, it ends in default. They just default. Argentina is a good example. You can set your watch by Argentinian defaults. They happen like every 10 years, like clockwork. But that's because Argentina, but a lot of other countries as well, they can, we say, why can't they just print the money? Well, the problem is they print pesos, but they borrow in dollars. So if you owe dollars, you can't print the money because you don't have a dollar printing press. You have a peso printing press or any other currency that you want to name. So you can't print the money to pay back the debt because you owe it in a different currency. You owe the debt in dollars, but you print pesos. So that doesn't do you any good. So what do? Well, you just default. Sorry, not paying you. Too bad, banks. Have a nice day. Now, the U.S., so that's usually what happens. The U.S. doesn't have that problem because we can print the money. So I don't expect a U.S. default because we owe $37 trillion. It's like, fine, print up $37 trillion, ship it over. But good luck buying a loaf of bread, because what you do get in that situation is hyperinflation. So there's no reason for the U.S. to default. There's no reason for the U.S. to restructure. We actually can print the money to pay off the debt, but that has consequences, and there are two. One is what I just described, which is really slow growth. The other one is hyperinflation. So right now, and that threshold, by the way, is 90%. That's 90% approximately is where you tip from getting more than $1 worth of growth to getting less than $1 worth of growth. That's why it's a red line. We're way past that. We're under 37% or high, we're somewhere in the mid 130s. We're with, who's at our lunch table? Lebanon, Greece, Italy, Japan, the super debtors of the world. That's where we are. So how do you get out of it? Well, in the end, it's hyperinflation, but not right away. I'm not saying hyperinflation tomorrow or next month or next year. What you really get is slow growth. It's just a slow grind down. The rich get richer. The middle class gets demolished. Younger people can't afford, can't save, they're stuck in their parents' homes, can't get their own homes. Investment dries up, productivity declines, and you get this just slow growth, occasional recession stage that lasts for a long time. And again, Japan is the example. Japan's the model for this. We are Japan. So we're in, this is why I say we've been in a depression since 2007. We're in this slow growth phase. It's getting worse. But if somebody says, hey, Jim, we had 2.6% growth in in the fourth quarter of 2024, where's the recession? 2023, where's the recession? I'll say, well, it's coming. But the problem is you got that growth by borrowing more than you grew.